multifamily mindset.
Podcast. Think bigger.
Hey everyone, welcome back to the Multifamily Minute. This is Kyle, your hostess with the mostest, and today we're diving into a topic that's foundational to multifamily investing, and that's cap rates. So if you're brand new to the game and you're just hearing this term for the first time, or you're a seasoned investor and you're looking for a fresh perspective, this episode is for you. We're going to break down what cap rates are, why they matter, and how you can use them to evaluate your deals. Plus, for some of you more seasoned investors out there, I have an analogy that I like to use and look at cap rates as, so maybe it gives you a fresh perspective on just how you can look at cap rates moving forward. So let's start at square one. What exactly is a cap rate? In the simplest terms, the cap rate, or capitalization rate, it's a formula that helps you understand the return on an investment from a property. So the formula is your net operating income divided by the purchase price. I don't want you to get too caught up in it, but here's an example. Say you're looking at a property that costs $1 million and it generates $100,000 a year in net operating income. That property has a cap rate of 10%. Simple, right? Cap rates essentially tell you how quickly you can earn back your investment, assuming nothing major changes in the income and expenses, of course. But it's important to note that cap rates don't tell the whole story. They're just the starting point. So while they're helpful, there's more to the picture, which will bring us to the next question. Why do they even matter? And it's a great question. I mean, why are cap rates such a big deal? Well, they're important for a couple reasons. First, cap rates give you a way to compare properties. Think of them as the common language of real estate deals. If you're evaluating two properties in the same market and one has a cap rate of 5% while the other one is 7%, that tells you something about the risk and potential return of each deal. Second, cap rates reflect market conditions. So in hot markets with lots of competitions, you'll often see lower cap rates because investors are willing to pay more for the same income. And in slower markets, cap rates tend to be higher because there's less demand. But here's the catch. While cap rates are incredibly useful, they're just one piece of the puzzle. But they don't account for things like your financing or your future growth or even the physical condition of the property. So how would you actually use them? Well, let's dig into that. Because now that we know what cap rates are and why they're important, let's talk about how you can use them as an investor. One, it's to evaluate risk. Cap rates are often a good indicator of risk because a lower cap rate usually means lower risk, but also lower returns. While a higher cap rate might mean higher returns, but with greater risk. Remember what I said earlier, in a hot market with lots of competition, you'll see that low cap rate. But when there's not as much competition, you will see that high one. Now, two, it's just to help you set your expectations. Cap rates give you a ballpark idea of the kind of return you might expect to achieve in a specific market for a specific type of property. Now, getting into that, it can get a little confusing sometimes, but if the average cap rate in your target market is 6%, you can roughly expect a 6% annual rate of return on your investment based on the property's net operating income. But that is, again, as I said before considering financing or other factors. Now, three, this is to spot opportunities. If you know the typical cap rate for a market and you come across a property with a cap rate that's significantly higher or lower, it's a signal to dig deeper and figure out why. So if it's a higher cap rate than what the average is in the market, what we call your market cap rate. So if it is a higher than your market cap rate, why are they trying to sell this property at such a discount? And if it's lower than where the market cap rate is, why are they putting such a premium on this property? But, and this is a big but, cap rates don't always tell the full story. Sometimes a deal that looks great on paper can have some serious red flags hiding just below the surface. And this is actually where one of my favorite analogies come in with a car, right? So imagine this, you're looking for a new car and you're scrolling through listings and you come across someone selling a brand new Ford F-150 for half the price. It's shiny, spotless, looks like a dream, maybe only has 5,000 miles on it. But what's the first thought that pops into your head? Probably something like, what's the catch? Is it stolen? Does it have hidden damage? Was it in a flood? I mean, buying property at a high cap rate can be a lot like that. At first glance, it seems like a steal. A higher cap rate means better returns on your investment, right? But actually, high cap rates often come with strings attached. Maybe the property's in a declining market. Maybe it's in poor condition. And with poor condition, you have to put in significant repairs, so expect that CapEx budget to go up. Or maybe the income just is not as stable as it seems. Maybe there's a lot of volatility, maybe there's a lot of month-to-month contracts. That's why your due diligence is so critical. Just like you wouldn't buy that car without taking it to a mechanic, you probably shouldn't buy a property with a high cap rate without digging into the details. So let's bring it all together. Here are the 3 key things to remember about cap rates. 1, they are great tools for evaluating deals, but they are not the full story. 2, low cap rates often mean lower risk, but also lower returns, while high cap rates might signal higher risk and potential issues. 3, always do your homework. Treat a too good to be true property the same way you treat a suspiciously cheap car, with healthy skepticism and thorough investigation. Cap rates are incredibly useful, but again, they are just one piece of the puzzle, so I want you to use them wisely, and you'll be one step closer to making smart investment decisions. Anyways, I hope you found this episode extremely helpful. I appreciate you guys tuning in to the Multifamily Minute. So whether you're just starting out or you're already navigating the world of multifamily, understanding cap rates is a skill that will serve you so well. And again, if you did enjoy this, please share it with someone who might find it helpful. And as always, stay curious, stay focused, and I'll see you next time.
Multifamily mindset.
Podcast. Think bigger.